The more they kick the can, the more the obligations build up. So it's like a game of cat and mouse. We didn't see a rise in IV on Thursday before OPEX in June. If it increases more tomorrow, that's super bullish to me. It seems like a decent indicator. Yeah, but we did in September, and we definitely did in August. Beyond Reg Show 816, no shares to borrow and borrow rate at 77%. Looking at OI, maybe someone knows they need to cover. Yeah, that sounds very possible. You know, over time, this consistent volatility shorting eventually dries up the company's ability to get equity from its own common stock and can drive them out of business. The biggest difference on GME is that people keep buying it, right? Whereas other stocks, they do this too. Every time it spikes, more people sell, right? So, you know, on stocks like other stocks in the basket, they are slowly driving them out of business by shorting their volatility over time, because every time they cover their volatility shorts and the price spikes, long-term shareholders sell out, right? Repeated cycles of very, very low pricing to very high pricing are just going to encourage long-term holders to sell their positions. On GME, we keep buying the bottom instead of selling the top, right? And then what that does is, you know, instead of the volatility short over time creating a downward trajectory, GME's volatility short over time creates an upward trajectory until they can get sufficient liquidity to short it back down, and then it starts again. So if you actually look at GME price action since since January 2021, you know, after we hit like well, actually after February. So after the low, so liquidity was at its highest here in January. This is when the most people sold GME ever. Which allowed them to bring the price really, really low, right? But in bringing the price really, really low, synthetically, they had to cover their volatility short. And then we got Feb OPEX, which is really what started the whole buy and hold mentality, right? And then, you know, after Feb OPEX, we got another spike for March OPEX. And then we kind of dwindled off into the share offering in April. Then, you know, we got May OPEX, which led into earnings. And then we came down into you know, July, where a massive amount of GME liquidity was dumped, which meant that August OPEX, you know, really didn't have a lot of obligations to solve. So it was very rapid and died off quickly. But with the transfer of ETFs, you know, they now had less liquidity to short with, because when GME was in the Russell 2K, and this is where everything kind of changes on GME, because with everything in Russell 2K, GME was very liquid in ETFs. And so they were able to, even though demand was extremely high, they had tons of ETF liquidity to stifle price action. After GME moved to the Russell 1K, they lost 12 million shares of, you know, ETF liquidity per day, right? Like compounded across each trading day, which is, you know, over a quarter billions of shares. Well, not a quarter, but maybe like over half a year, billions of potential short sales that they cannot transact anymore. And sure, they used that big liquidity dump from the sale and from the ETF rebalance to clear out GME's underlying FTDs. But they then had the problem where they had to short volatility with less liquidity, right? And then we start to see GME get more, it gets a little more touchy. It gets much more sensitive to buy pressure after August OPEX. And, you know, we see the November spike where they have to off risk the basket on the November ETF FTDs on November 3rd. We see a massive like OPEX for November, but cleared early, right? And then, you know, finally they have enough liquidity at the end of the year to really short us hard again. And they do. They short, you know, all the way through January, February, into March. But by the time March hits, they have a ton of obligations built up again. So, you know, we repeat this cycle. And now, you know, people are buying. And since the split, people are buying even more. I think retail shareholding's going up. And that puts, you know, even more pressure on the ETF liquidity, because they have to lean on it more heavily. But because of the split, GME FTDs are going to be very low now. Like we're probably not going to see GME fail a lot anymore. But since we keep buying the bottom, you know, over time, you know, our baseline prices go up. And you know, GME very much, if we go out here on TradingView, it's really easy to see. Give me a second. So if you actually look at GME over time, you know, you see that effect. You see that effect of us buying the bottom, which means that when they run the price to try to get us to sell, no one's really selling, right? Like we're selling our options contracts up and stuff, which gives them enough liquidity to short it back down, but no one's really selling their shares, right? So they need a bunch of liquidity, and this massive drop got them that, right? So, you know, they got enough leverage to tank the price from, you know, what did we hit? Like 255 down into like the 180s, 150s. And that scared people enough to get them another round of liquidity to short, right? But then, you know, this year we start the same pattern again. It's a little lower and interest isn't as strong, but it's still there. We're still buying, right? We're still pressuring that floor. And one of the great things about us buying the dip is, sure, it doesn't improve price, but it keeps them from dropping the price lower because our demand picks up massively the lower the price gets. You're nerding out too hard right now. The pores are getting too jacked. Tone it down, Papa. I can see those nips from here and they're hard as diamonds.